Let us start this wonderful chapter, investment accounting. Investment accounting is AS-13. Investment accounting is AS-13. This is a part of your accounting standard also, and this is a part of your regular chapters also. So we are going to first discuss what is accounting standard 13, investment accounting, and then we will take a large number of questions on investment accounting, which is a very important chapter, and questions from 4 marks to 20 marks have been asked on this topic. What is the range of this topic? 4 marks to 20 marks. So you can't afford to miss it, and with your cooperation we will be able to take a large number of questions in the classroom itself, and all your doubts will be resolved. Okay, so now you can ask me any query related to investment accounting AS-13 only. So please open your book, investment accounting chapter. First few minutes we will study the provisions of accounting standard 13. First we will deal with accounting standard 13, because the accounting will be based on AS-13. Okay, so unless you know AS-13, you can't do justice to investment accounting. And if you try to do justice, there will be injustice. You may make mistake, because in India, companies which follow accounting standards, they have to do the accounting of investments as per AS-13 only. So we will start with AS-13 today, and we will take few questions also today under AS-13, and then from next lecture onwards we will take many advanced questions which are asked in the exam for 4 to 20 marks. Are you ready for this wonderful chapter, investment accounting? First, what are investment? What are investment? What are investment? Do you also make investment? Please reply. And please reply, where have you made investment? Yes, student, start. Where have you made investment in your life? Where have you made investment? Investments are asset held. Investments are asset held. So these are assets. Asset means resource. Assets means resource which are controlled by entity. Asset means resource which are controlled by entity. Okay, so the student have started answering. They have purchased share, gold, fixed deposit, mutual fund. Okay, some are investing in SIP, share, studies. Oh, one person is saying we are investing in studies also. That was a good answer. Investments are, first point, assets. Why are investments held? Why are investment held? What is the purpose of holding the investment? The purpose of holding the investment is to earn income. The purpose of holding the investment is to earn income. And how do you earn income? You earn income in the form of dividend, interest, rentals, capital appreciation, or for other benefits to the investing enterprise. So the purpose of the investment is to get dividend. Example, on which investment you get dividend? So investment in shares. Investment in shares and mutual fund and mutual fund will give you dividend. So we invest in mutual fund to get dividend. Which investment will give you interest? So investment in FD, investment in debenture, okay, or bonds will give you interest. Which investment will give you rental? Investment in properties, investment in land, building, okay, these are called real estate or properties. This will help you to earn rental. Which investment will help you to earn capital appreciation? So investment in gold, somebody said gold, silver, shares, mutual fund, real estate. Here the objective of making investment is properties is to earn capital appreciation, and sometimes there can be other benefits also. Other benefits would be like, for example, bonus share. You may get bonus share, you may get right shares, you get voting rights, you get control over the company. Okay, so these are other benefits of holding the investment. Tax benefit, there are tax benefits. So let us revise. The purpose of holding investment is to earn dividend, interest, rental, capital appreciation, or for other benefits. Investments are assets which are held by an investor for the following purposes. Okay. So I hope the definition of investment is clear. Assets held as stock in trade are not investment. Assets which are held as stock in trade. Stock in trade means the objective is to buy and sell frequently. The objective is to buy and sell frequently. That is called asset held as stock in trade. That is held for trading purpose. Held for trading purpose only. One student is answering inventory. Oh my God, we are on investment chapter and this fellow is answering inventory. I knew this. I knew this. Somebody will say in inventory. We are not talking about inventory. We are talking about such type of assets which are like investment only. Okay, like for example, derivatives, or even for some dealers, bonds are inventories. Anybody, bonds are stock in trade. Anybody can buy and sell anytime. They are just ready to sell and buy anytime. So when your objective is to buy and immediately sell, then in that case it is stock in trade. Stock in trade, which can be your physical inventory AS2, but this is not AS2. We are talking about other types of instrument which are held with the sole objective of trading in them. Like you do, morning you buy share, afternoon you sell the share. That is not your investment. That is your stock in trade. If your objective is continuous buying and selling, then it is not investment. Okay. Asset held as stock in trade are not investment. Question for you. Why investment accounting is required? Please reply. Why investment accounting is required? Why investment accounting is required? Accounting, I am not talking about investing. That is a different issue. You are an investor. You have many investment. You have invested in shares of Tata Steel, Reliance Industries, okay, Bajaj Auto Limited, TCS, Infosys, D-Mart, okay, HDFC. But why you need a proper standard on this? Why you need a proper accounting basis for this? The answer is, as somebody rightly pointed out, that if an investor holds large number of investment, then he needs to find out the profit or loss on his investment transactions. Okay. If he does not maintain investment accounting properly, he will not be able to ascertain profit. He should know how many shares or securities we are holding. We should know what is the value of our securities. We should know whether we have received all interest or dividend or not. Okay. So these are the benefits. To a certain profit earned on investment. Most of you are saying to a certain profit earned on investment. That is right. But in addition to that, one should also know how many shares or debenture you are holding, what is the valuation of those shares or debenture, whether you have collected all the interest and dividend or not. And with that background, we are going to learn now investment accounting. When is AS-13 not applicable? Accounting standard 13 is usually applied for investments, but there is a scope paragraph in AS-13. Scope paragraph means where it is not applicable. Where it is not applicable, that means this standard is not applicable in the following situations or transactions or events or assets. First is, this standard does not deal with the basis for recognition of interest, dividend and rent. Make it clear. This standard deals with accounting for investment. This standard does not deal with how interest, dividend or rent will be accounted for. Accounting of interest, dividend, rent is covered by another standard which is called AS-9, revenue recognition. This standard does not deal with operating and finance lease, which is covered by AS-19, leases. This standard does not deal with investment of retirement benefit plan and life insurance enterprises. So in India, there are insurance companies. Insurance companies are major investors in India because they have lot of money received from policyholder which they invest. But insurance company will follow IRDA guideline. Insurance company will follow IRDA guideline. Insurance company will follow IRDA guideline for accounting of their investment. So this standard AS-13 is not applicable to such insurance companies. Then in India, there are many mutual funds. You invest in mutual fund. Mutual fund also invest in other securities. So for example, you have a HDFC mutual fund. You are investor. You have invested in HDFC mutual fund. The HDFC mutual fund manager, he also invests in securities. He also invests in various types of securities. So your money is invested by mutual fund in another securities. This company will not apply AS-13. This investor will apply AS-13, but mutual fund will not apply AS-13. For mutual fund industry, there is a separate guidance note. There is a separate guidance note, so they will follow those guidance note. Next is venture capital funds. Who are venture capital funds? They invest in risky businesses. They invest in risky businesses. So they are also investor, but they invest in highly risky business. They will also follow guidance note issued by institute. They will not follow this standard. And then what about banks and public financial institutions? They will follow RBI guideline, not this standard. So this is just a scope paragraph. Which situation or which entities are not required to follow AS-13. Now we will see accounting. Classification of investment. For accounting purpose, you need to classify the investment. You need to classify the investment into two categories. Which two categories? It is called current investment and second one is called long-term investment. First one is called current investment, second one is called long-term investment. Now your interest would be in knowing how do I identify whether an investment is a current investment. So you will try to answer. Okay, try to answer. Guess what is current investment. Guessing is allowed today. Use your imagination. Any wild guess is also allowed. What is current investment? How will you know whether this is current investment or not? Yes, anybody wants to answer? Investment hold for not more than 12 months. One student is saying investment hold for not more than 12 months. Within 1 year, 12 months, 1 year. Investment which are sold within 1 year. Investment which can be realized in cash within 1 year, 1 year, 1 year, 1 year. Held for less than 12 months. Okay. Most of you are only answering some portion of the definition. Let us see what our institute has to say on this. Accounting standards are issued by Institute of Chartered Accountants of India. Okay. So that standard says a current investment is an investment. First condition is that is by nature readily realizable. That is by its nature readily realizable. You will find this is written in the notes. And second condition, and means both conditions, is intended to be held for not more than 1 year from the date when such investment is made. So we are going to repeat it again. First condition is that they are by their nature readily realizable. Readily realizable. Then your query will be, what is readily realizable? So readily realizable means can be easily, quickly, or without loss of time, or without loss of time, be converted into cash, or can be converted into cash. That is the meaning of readily realizable. Okay, which can be converted into cash in short period of time. Okay, now I have written some example there. I have written some example there. Land, building, gold, shares, mutual fund. Land, building, gold, share, mutual fund, debenture, preference share, okay, government bond, government bonds which are traded and which have lock-in period, okay. So these are some investment. One student is saying which are highly liquid investment which are readily realizable or converted into cash. Where I have written highly liquid investment? It should be easily convertible into shares, into cash. Highly liquid is not necessary. Yes, it should be liquid, but very high liquidity is not required. Like for example, gold may not have a very high liquidity, but it is liquid. Okay. Shares may not have very high liquidity, but they are liquid. Okay. High liquidity is not required. They should be readily convertible into, they should be readily realizable. Okay. Now, if I apply the definition of current investment to this investment I have written on the right side, you will find that some investment will never classify into current investment because they are not readily realizable. Example, land. Land is not readily realizable. It is time consuming to find a buyer and sell the land. Building is not readily realizable. Difficult to sell building in a short notice. It takes lot of time to find a buyer, negotiate with him, give a notice in the newspaper and complete all the legal formality. So land and building can never be current investment. Then there is a example of government bond which has a lock-in period. Lock-in period means it cannot be transferred. It will get blocked. So this also does not satisfy readily realizability criteria. However, gold, silver, share, mutual fund, debenture, preference share, government bonds which are traded on the exchange, they are readily realizable. Even in case of mutual funds and shares, in case of mutual funds and shares, if there is a lock-in period, if there is a lock-in period means it cannot be transferred, then they are not readily realizable and then they cannot be classified as current investment. Can shares have lock-in period? Yes. For example, in case of share, if an employee receives shares from the company, company will put a condition on him that for 3 years he cannot transfer the shares. Then these shares will not have liquidity. They are not readily realizable. Similarly, mutual funds, if you invest in equity linked saving scheme mutual fund, ELSS, section 80C, you will learn or you have learned, I don't know, which says that you can invest in equity linked saving scheme of mutual fund where you will get deduction up to rupees 1,50,000. However, once you invest in this ELSS mutual fund, your funds are blocked for 3 years. That means for 3 years you can't realize. Hence, it will not be a current investment. So, point number 1 I have explained, they are readily realizable. Land is not readily realizable, building is not readily realizable, and investments which have lock-in period are not readily realizable. Example of investment which have lock-in period is sometime equity shares issued to employees or promoters have lock-in period. Mutual fund scheme which are ELSS scheme have lock-in period. Government bonds are lock-in period. For example, if you buy that National Savings Certificate NSC, for 5 years you cannot redeem it. If you buy National Highway Authority Bond of India, Rural Electrification Bond of India, you are not going to sell it for 5 years, and therefore they don't have liquidity, therefore they are not current investment. What about, question to you, what about, are you listening to me? What about shares of private limited company? What about shares of private limited company? Suppose you have invested in AS Foundation Private Limited. Is it a current investment? Is it a current investment? AS Foundation Private Limited shares. Is it a current investment? Please reply fast. Is it current investment? Use both hand and type. Is it current investment? The answer is, the answer is, the answer is no. It is not listed. It is unlisted. It's a private limited company, so they are not listed. You will find it very difficult to find another buyer for such shares. Difficult to transfer shares in case of private limited company. So investment in private limited company cannot be current investment. Okay. Now let us analyze the second line of the definition. Intended to be held for not more than 1 year from the date when such investment is made. So if you have purchased the investment on 1/4/21, the intention should be to hold it for less than or 12 months. The classification has to be done here. On the date of acquisition, I have to classify the investment as current or long-term investment. So therefore, on that day, ask yourself, suppose you are this person, ask yourself, okay, ask yourself, talk to yourself, what do you want? What do you want? What do you want? What do I want? So he's dreaming, what do I want? He says, I want to hold it for less than 12 months. This investor says, I want to hold it for less than 12 months. And assuming condition 1 is satisfied, then it is a current investment. But if his first condition is satisfied, second is not satisfied, he does not want to hold it for less than 12 months. He wants to hold it for a longer term. He wants to hold it for a longer term. Then it will not be current investment. So therefore, there is one question arises. How to check intention? How to check intention? So normally, the board of directors, they pass resolution, and in the resolution they mention about their intention. In resolution they mention about their intention, that whether the objective of making the investment is short term or long term. So not a difficult idea. Now you will ask me one question, We have purchased shares on 1/4/2021. The intention was to hold for less than or equal to 12 months. Intention was less than 12 months. So year ending date is 31st March 2022, but the investment could not be sold. Oh my God. So what will be the classification on 31st March? Your intention was not to hold it. Your intention was to hold it for less than 12 months. But there was corona, there was market crash, nobody was interested in trading in shares. You could not sell it within 12 months. So now we are standing on 31st March 2022. What will be the classification? Can I still call it as current investment, or do I need to reclassify it to long term investment? So I will give you two options. I tried to sell, but I could not sell. My intention continues. My intention has not changed. My intention is to sell it, but I am not able to sell it for any reason. So I am still going to classify it as current investment only, because my intention has not changed. My intention is still the same. For some reasons we could not sell it. So there were some students who said the answer is long term investment. The answer is not long term investment. If the intention does not change, intention is to still sell it. As soon as we'll get an opportunity to sell, we will sell it. Then we will call it current investment on 31st March 2022 only. So it is not mandatory to sell it in 12 months. Intention must be there. Wah wah. Intention must be there. Okay. As long as intention is there, institute is happy. Now the question is, what is a long term investment? Long term investment means all investments minus current investment. Wow, what a equation. Long term investment means all investments minus current investment. That means if an investment is not current investment, it is long term investment. So how do I check whether it is long term investment? Either it is not readily realizable, or intention is to hold for more than 12 months, or if the intention is to hold for more than 12 months. If the intention is to hold for more than 12 months, either it is not readily realizable, or it may be readily realizable, but the intention is to hold it for a longer term, more than 12 months. So if that intention is clear that I want to hold it for more than 12 months, at the time of acquisition, this intention has to be checked at the time of acquisition, then in that case it will be long term. Can the intention change later on? Yes, but that is a separate discussion. Intention can change later on, and if the intention will change, the classification will also change from current investment to long term investment. Is it right? Next concept today, cost of investment. Cost of investment. So when you will buy investment, you will incur certain cost. So which all cost will be included in the cost of investment? in the cost of investment. So they will also be added, and then you will find out what is the total cost of investment. Very important. This I will require while solving the numerical examples. The cost of an investment should include acquisition charges. Cost of investment will include acquisition charges. That means cost which are required to acquire investment. Cost required to acquire investment is called acquisition charges, such as brokerage, fees, duties, etc. Okay, duty means stamp duty. When you buy shares, properties, etc., then you have to pay stamp duty. You have to pay fees. Okay, you have to pay fees like brokers fees, consulting fees, or brokerage. Nowadays GST also. If you are getting credit for GST, input credit for GST, then don't add. If credit for GST is available, then don't add. If credit for STT, yes, STT can be added. Okay, there are some taxes they also levy on you. Add those item also. So those will be called acquisition cost. Nowadays shares or securities are held in electronic form. Shares are held in electronic form, like you have to open a demat account, and then you have to pay annual demat charges. Annual demat charges is for holding the securities. Annual demat charges are holding security. They are not for acquisition, hence not included. Demat charges not included in cost of investment because they are not for acquisition. They are for holding the security. Whether you hold 1 share or 10,000 share, you have to pay some demat charges. Even if you have 0 share in that demat account, then also you'll have to pay demat charges. So all this is called acquisition related cost. Okay. If you hire some consultants, portfolio manager, they will charge you fees. That portfolio manager's fees will also be included. AMC fees. AMC, what is full form of AMC? Somebody asked me this question. I don't know. What is AMC? What is AMC? Any answer? AMC? And how is it relevant in the current context? That AMC is the fees only. Okay. AMC means asset management companies. They charge a fees. So fees is already written here. Okay. Asset management companies, they charge you a fees, not maintenance charges. I knew somebody will say that. Some of the students are saying funny things. Annual maintenance contract. My dear, we are talking about investment and you are talking about annual maintenance contract. Oh my God, such darkness here. Students are in darkness. They don't know what is AMC. They are writing annual maintenance contract. I am going to the 6th floor of this building. Why? I have to jump. Because this is the answer I got for AMC in the context of investment. Okay, let me complete the syllabus and then maybe I will jump. Okay. nalayak, useless. This point now. This point is printed below, where acquisition of share of a cooperative society or company is necessary for owning a property. The cost of such share should be added to the cost of the property. The cost of such share will be added to the cost of the property. Understand what they are trying to say? Suppose this is a building in a cooperative society and you have purchased a flat here. Flat purchased, okay. But in a cooperative society, if you want to purchase a flat, you have to purchase shares of cooperative society. You have to purchase shares of cooperative society. You have to purchase shares of cooperative society. So if the flat will cost you 50 lakhs, shares of cooperative society cost you 20,000, the total cost of this flat will be 50.2 lakhs. So even the cost of buying share in a cooperative society or a company which is required to become the member of that cooperative society will also be added to the cost of the property. In addition to brokerage fees duty, you will add the cost of buying shares in a cooperative society also to the cost of investment. Is it right? To summarize our discussion on cost of investment, cost of investment will consist of basic purchase price and other incidental expenses which are incurred to acquire the investment. To acquire investment, other cost like brokerage fees, duty, okay, some taxes also. This was for this was for purchase of investment by paying cash. Now we will also take a situation where investments are acquired by issue of shares or other security. Investments are acquired by issue of shares or other securities. Example: Mukesh, Anil. Mukesh and Anil are two friends. Okay, Mukesh and Anil are two friends. Mukesh will issue 100 shares to Anil. Anil will also issue 500 shares to Mukesh. Mukesh will issue 100 shares to Anil. Anil will issue 500 shares to Mukesh. What entry will be passed in the books of Mukesh and Anil? Here there is no cash transaction. Share for share. You pay me 100 share, I will give you 500 share. Okay. So here the standard has a rule. Rule: when securities are exchanged, share when securities are exchanged, the rule is, if the investment is acquired by issuing shares or other securities, then the fair value of the security issued, fair value of the security issued will be taken as the cost of consideration, will be taken as the cost of consideration. Okay, so I will now keep the example for you. Write one example. Immediately we will create an example. Example in the notebook. Example in the notebook. Mukesh Limited. Mukesh Limited acquired 100 shares from Anil Limited. Mukesh Limited acquired 100 shares from Anil Limited by issuing 500 of its own shares to Anil Limited. By issuing 500 of its own shares to Anil Limited. Fair value of Mukesh Limited and Anil Limited's fair value of Mukesh Limited and Anil Limited shares are rupees 20 and rupees 95 respectively. Are rupees 90, 20 or 95 respectively. Just read what is written here. Those who are asking query without reading, after reading, ask the query. Don't shoot in the darkness. Okay. It is written very clearly, the fair value of security issued will be taken as the cost of acquisition. Fair value of security issued will be taken as cost of acquisition. Somebody is using his own standard. Some student have written his own accounting standard. His name is Banjangi Shraman. That is your standard, dear student. Okay, students AS, not ICIAS. IC has written fair value of security issued is the cost of acquisition. Students Ind AS says, student AS says, whichever is more clearly evident, which is not printed here. Kindly check your book. Okay. So this is the example. Now question write down, pass journal entry in the books of Mukesh, Limited, full stop. Face value of share is rupees 10. Face value is rupees 10. Okay. Face value is rupees 10. Now pass the entry in the books of Mukesh Limited. You are suppose accountant of Mukesh Limited. What entry will you pass? What entry will you pass? Pass yourself and give me the answer. Today your intelligence is at a test in full public view. Pass entry in the books of Mukesh Limited. By applying this paragraph, fair value of security issued will be taken as the cost of consideration. So in the books of Mukesh Limited, investment in Anil Limited, you have issued 500 of your own share. It's written here, fair value of security issued 500 into the fair value of Mukesh is 20 into 20. Come on, 500 into 20, debit 10,000 to share capital 500 into face value 10 rupees is 50,000 and 2 securities premium is also 500 into 10, 50,000. So this is the answer. This is the answer. Is it right? 500 into 10 is 5,000, correct, sorry. And 2 securities premium 5,000. 1 0 I put extra. You people have given me so much stress. that I forgot the basic calculation only. Okay, sorry. 5,000, 5,000. One student has written the entry correctly, but he has not written the amount. So this is the answer. Now my question is one more question. One more question. Pass entry in the books of Anil Limited. Pass entry in the books of Anil Limited. Pass entry in the books of Anil Limited. Suppose you are in the books of Anil Limited. What entry Anil Limited will pass? What entry Anil Limited will pass? Anil have issued 100 shares. Anil has issued 100 shares to Mukesh. Anil's fair value is 95. Anil's fair value is 95. So in the books of Anil Limited, write down. In the books of Anil Limited, investment in Mukesh Limited, 100 share issued by Anil, market price is 95, debit 9500, to share capital, 100 share into 10 rupees, face value 10 rupees, 1000, and balancing figure 2 securities premium. 2 securities premium. Anil Limited will record investment in Mukesh Limited at fair value of share issued. 100 shares were issued at rupees 95. 100 shares were issued at rupees 95. So the answer is investment in Mukesh Limited account debit 9500, to share capital account 1000, to securities premium 8500. This is the right answer. Amazing. This is case number 1. Non-cash consideration. Shares or securities are issued to acquire the investment. Take fair value of security issued. Take fair value of security issued. Another example, investment acquired in exchange for another asset. Investment acquired in exchange for another asset. Now this is investment acquired against issue of security. So when you are issuing security, take only fair value of security issued. But if you are acquiring investment by issue of some other asset, so now here we will take, if the investment is acquired by giving any other asset, then fair value of the asset given up. Here we have two choices, fair value of the asset given up or fair value of the investment acquired. If it is more clearly evident, will be considered as the cost of acquisition. So here it is FMV of asset given up or FMV of investment acquired, whichever is more clearly evident. Now it is proper. Okay. Now what do you mean by whichever is more clearly evident? More appropriately determined. More appropriately determined. More appropriately determined means less subjectivity. Less subjectivity and more objectivity. Less judgment involved. Less judgment involved. That is the meaning of more clearly evident. That is the meaning of more clearly evident. Understood? See the example. Mukesh, Anil, Mukesh, Anil. Mukesh has given his second hand car to Anil. Mukesh says, Anil, take my car and give me your shares. Anil gives him 100 shares. Anil gives him 100 share, and Anil is a listed company. Anil is a listed company. Anil is a listed company. Now you will answer. I will wait for your answer. Whose fair value is more clearly evident? The fair value of the car given, which is a second hand car, or the fair value of the shares acquired, which is the share of a listed company which is traded on the stock exchange? Quickly answer. Share is more clearly evident. Share is more clearly evident because it is listed company share. Because it's a listed company share, so I will take fair value of the shares for the purpose of accounting. I will take fair value of the share for the purpose of accounting. So Lucky is saying fair value of share. Sanket Jain, Gautam Saxena, Lakshana Ramesh, Padamja, Thanga, Anirudh, they are all saying fair value of share. You are right. So I will convert this into an example for you. Okay, so write down example. Anil Limited, sorry, Mukesh Limited, right? My friend is Mukesh. I make friendship with Mukesh type people, not Anil type people, okay? Mukesh Limited acquired 100 shares of Anil Limited by transferring a second hand old car to Anil Limited. By transferring a second hand old car to Anil Limited. Okay. Fair market value of car is rupees 3 lakh. Fair market value of Anil Limited's share is rupees 3050 per share. Anil Limited is a listed company. Anil Limited is a listed company. Pass journal entry in the books of Mukesh. Pass journal entry in the books of Mukesh. Pass journal entry in the books of Mukesh. So in the books of Mukesh, Mukesh has acquired investment in Anil. So Mukesh will write investment in shares of Anil Limited account debit to car account. The question is, what is the amount you are going to put here? Amount. How much amount will you put? How much amount you will put? 100 into 3050 or 3 lakh. 100 into 3050 because it's a listed company. So the answer is right. Somebody gave that answer. Lakshana Ramesh, how much is 100 into 3050? Let me try. Today my mind is not working. 3,05,000. Is it 3,05,000? To car 3,05,000. First you write down the entry. Then I will give you two more points. 3,05,000 is right. Most of you are right. Write down note. Fair market value of listed company share is more clearly evident than a second hand old car. A second hand old car is more clearly evident than a second hand old car. Is more clearly evident than a second hand old car. One more line write. One more line write down below. One more line write down below. Below write down, I am writing on the left side. Mukesh Limited will also account for gain or loss on sale of car. Mukesh Limited will also account for the gain or loss on sale of car. Govardhan Reddy is right. Govardhan Reddy, where do you stay? Have you noted the answer? Have you noted the answer? Yes. So everybody has noted the answer. Okay. Have you enjoyed this example? Say yes. Now we are going to change the example. Now we are going to change the example. Okay, Govardhan Reddy stays in Andhra Pradesh. That I know. But which place in Andhra Pradesh? From your name I understood. Andhra Pradesh Reddy. Okay. So now you write down example number 3. Two examples I have dictated. So example number 3 is, now I will say Mukesh Limited acquires 100 shares of Anil Limited. Mukesh Limited acquires 100 shares of Anil Limited by transferring Anantapur. Govardhan Reddy is from Anantapur. By transferring a brand new car. By transferring a brand new car. By transferring a brand new car. Mukesh Limited acquired 100 shares of Anil by transferring a brand new car. Fair market value of new car is rupees 5 lakh. Fair value of shares of Anil Limited is rupees 5,150 per share. Per share. Anil Limited is an unlisted company. Anil Limited is an unlisted company. Pass journal entry in the books of Mukesh. Pass journal entry in the books of Mukesh. Okay. So solution. Books of Mukesh Limited. Journal entries. Books of Mukesh Limited. Journal entries. So debit will be investment in shares of Anil Limited. Debit to car account. To car account. Now the question is, whose fair market value is more clearly evident? Fair market value of a brand new car, you have just got it from the showroom, you have not even done the driving also for 10 kilometer, and you exchange it against Anil Limited share, but Anil is an unlisted company. It's not traded on the exchange. This fair market value is taken from some valuer, some valuation expert. So in this example, can we conclude that the fair market value of car is more clearly evident? Yes, most of you said car. 5 lakh is right. Fair market value of car is more clearly evident. Note, write down. In this example, the fair market value of car is more clearly evident. Is more clearly evident. Is more clearly evident. Second point, write down. Mukesh Limited will also account for gain or loss on sale of car. Mukesh Limited will also account for gain or loss on sale of car. Mukesh Limited will also account for gain or loss on sale of car. Mukesh Limited will also account for gain or loss on sale of car. Is it right? Say yes. Is it right? All of you agree? Mukesh Limited will also account for gain or loss on sale of car. Everybody has completed? Sai Prasad. Govind Thakur. So Govind Thakur, Sai Prasad have done. Kunal Pancharia, Lakshana Ramesh, all of you have done. Now there are two difficult questions for you. Mukesh Limited exchanges a brand new car against the shares of Anil, and Anil is a listed company. Anil is a listed company. Car is a brand new car. Shares are of a listed company. Shares are of a listed company. Then which number will you take? Then which number will you take? Suppose in this example, I just make a change. Anil is a listed company. Anil is a listed company and car is a brand new car. Then you have to apply your judgment. Standard has not given you any answer for this question. It says you take fair market value, whichever is more clearly evident. So normally the fair market value of the car will be more clearly evident than the fair market value of a listed company share. Why? Because the listed company share prices keep changing. Listed company share price will keep changing. Yes or no? Hello, ध्यान से. Listed company share price will keep changing. Take on your mobile phone. Type the name of any company share. Type the name of any company share. Is it right? Type the name of any company share. Let me try if my computer can do that for you. Suppose I take a company. Okay, which company you want me to take? Reliance. It's not working. Okay, forget it. Try on your mobile. Type any company's share price and you will find there is a graph which will appear on Google which will be like this. And if you just put, there is a 1 month tab, 1 year tab, 5 days tab. You press any tab now. What will you find? When you press any tab, the share prices are like this. How can you rely on such share prices? Is there any student which is showing a graph straight line like this? That whether it is Monday, Tuesday, Wednesday, Thursday, Friday, your graph will be same? The answer is no. Which means the fair market value of a listed company share is not as reliable as the value of a car. Today after the class you go to a showroom, ask for that car. Suppose there is a Mercedes car showroom. You ask him what is the price. Okay. Tomorrow also go. Again ask him tomorrow. Day after tomorrow also you go. Again ask him tomorrow. He will give you the same price. Oh my God. So the answer is, if there is a choice between the fair value of a brand new car and the fair value of a listed company share price, car will be given preference because that remains stable. Of course, that will change, but not as much as the price of a share changes. You can see in your mobile phone, any company you take, any damn company you take for 1 month, take for 6 days, take for 1 year, and the graph moves anywhere to anywhere. Therefore, car is better. Okay. Next point. Next point. So when there is a toss between fair value of a brand new car and listed company share price, take car. Now, the difficult question will be which you have not asked. Anil Limited is unlisted company. Anil is unlisted. And the car given is old second hand car. Oh my God. Car is second hand old car. Now what will you do? Now what will you do? This time you have to really apply the judgment. This time you have to really apply the judgment. But again my answer will be, the fair value of the car will be more stable, more you can say applicable, appropriate, more acceptable than the value of the share, because share prices are very volatile. Share prices are based on lot of assumptions and judgment about the future, and hence normally in such cases we'll take car only. Logic you have understood? Okay. One more question which comes to my mind, which your books will not answer you. When I am issuing shares, the standard says take FMV of security issued. But when I am exchanging assets against investment, when I am exchanging asset against investment, like this car example, the standard says whichever is more clearly evident. The standard says whichever is more clearly evident. So there is a difference in the treatment between what you are exchanging. If you are issuing your own share or security, then take the fair value of the security issued. But if you are issuing any asset, car, computer, building, and acquiring the investment, then you take fair market value, whichever is more clearly evident. The logic of that is, when the company is issuing its own share, it is using its own share like a currency. It is using its own share like a currency. It is using its own shares like a currency. So I don't have cash, but I want to buy. What do? I issue shares to you. I'm using my company share as a currency to make the payment. So therefore they say that you use the fair value of your share, which you are more or less using like a currency. Okay. Although that logic is not given anywhere, but that is how it is. So now you have to understand rule of valuation. Valuation of investment. The answer is, check what is the nature of the investment or classification of the investment. Accordingly, the investment will be valued. Very square important, very important. Because after this, our question answer session will begin, and in that question answer session, you have to check whether the investment is a current investment or a long term investment. On the left side of the screen, current investment should be valued at lower of cost or fair value. Should be valued at lower of cost or fair value. So first golden rule for today, if it is current investment, apply lower of cost or fair value. And the logic of this is simple. This is conservatism. Conservatism. If the fair value goes up, ignore. But if the fair value falls down, then record the loss. Loss will be recorded. Gain will not be recorded. So conservatism or prudence. What your teachers must have taught you, concept of prudence. Anticipated gain will not get recognized, but anticipated loss might get recognized. Second rule is determined either on an individual basis, that is preferred as more prudent, or by a category of investment like equity, preference, debenture, etc. What do you mean by point number 2? Suppose I have many investments. Investment in A Limited, B Limited, C Limited. I will take cost, I will take fair value. Suppose cost is 100, 200, 300. Fair value is 110, 90, 180. What I should preferably do as per the standard, I will take one by one. So my answer will be, A will be valued at 100 rupees because cost is lower. B will be valued at 90 rupees because fair value is lower. And C will be valued at 180 because fair value is lower. So this will give me lowest answer. This method gives me lowest answer, 100 plus 90 and plus 180, 370. So this gives me lowest answer. If I take total and then compare, that may not give me the lowest answer. For example, if I take total of all three investment, 600, total fair value of all three investment, 110 plus 90 plus 180, 380. If I take total fair value and total cost, then my answer will be 380. But if I compare on individual basis, one by one, then I will get the lowest answer. So concept of prudence will be ideally take one by one, and don't compare their totals. However, there is an exception. You can compare the total on the basis of category of investment. That means you can take all equity shares as one category, total cost versus total fair value of all equity share can be done, total preference share cost with total fair value of all preference share can be done, total debenture cost with total fair value of debenture can be done. So category wise totaling can be compared, but again the ideal situation would be to compare one by one. So that is, they are giving you a warning. Global or overall basis should not be adopted. On the screen, if I compare total cost with total fair value, it is called global or overall basis. If I compare one by one, this is called individual basis, which is preferred as more prudent. Next point, underline or highlight, comparison should be between cost and fair value. Comparison should be between cost and fair value, not between carrying amount and fair value, and not between carrying amount and fair value. Once again, comparison should be between cost of the investment and fair value of the investment. Comparison should not be between carrying amount and fair value. So what is the difference? Let us say in 2021, you purchased an investment whose cost is 100 rupees, whose fair value was 90 rupees. So you will write off investment by 10 rupees. You will write off the investment by 10 rupees. Yes or no? After writing off investment, you will pass the entry P&L account debit 10 to investment account 10. This is the entry for writing off investment value by 10 rupees. After this entry, your carrying amount will become 100 minus 10, 90. So I have three figures with me now. 90 is carrying amount, cost is 100, and fair value is 90. This is year 1. This is year 1. Now we'll go to year 2. In year 2, this becomes my opening balance, so carrying amount is 90. My cost will always remain same 100, because cost is like your birthday, it is logged. Cost will not change. But my fair value will become, let us say, 95. In second year, my fair value becomes 95. In second year, my fair value becomes 95. So all of you understand, in year 1, originally cost was 100 rupees, fair value was 90. I have written off 10, so my carrying amount became 90. Next year, my carrying amount in the books right now is 90 rupees. Closing balance of last year is the opening balance of this year, 90. Cost will always remain 100 because it was purchased for 100 rupees. But fair value, that is the market value, will change. And now the market value is 95. Can some of you please suggest me what is the accounting treatment in the year 2? The one who will give me right answer will get an award. One-way ticket to Jupiter. Okay. Returning you have to manage. Compare 100 with 95. One student is right. Sanket Jain is saying compare 100 with 95 and take whichever is lower. So the lower is 95, which means my investment will now be valued at 95. My investment will now be valued at 95, but my carrying amount is 90. My carrying amount is 90. So my left hand suppose is 90 and my right hand is 95. I have to increase it to 95. I have to increase it to 95. Okay. And you have to pass one entry in year 2. You have to pass one entry in year 2. Guess the entry for year 2. Entry in year 2 will be, I will write here right side, top right side, entry will be investment account debit 5 to profit and loss account 5, being rupees 5 written back, being rupees 5 written back. You can write back also. You can write back also. Is it right? First year I have written down by 10. Second year I have written up by 5 rupees by reversing the entry. So I have reversed the previous year loss. Okay. That is allowed. That is allowed. That is allowed. Okay. So this is about current investment. This all you keep in mind, we will require in the question coming below that. Now come to long-term investment. If the investment is a long-term investment, my objective is to hold it for a longer term. My objective is not to hold it for a shorter term. So therefore the prices will keep fluctuating. The prices will keep fluctuating. The standard says ignore such fluctuation. Ignore such fluctuation. Share prices will fluctuate. Ignore, and you will carry your long-term investment at cost. You will carry your long-term investment at cost. Principle number 1, long-term investment will be carried at cost. But then the student will ask me a question. Are we not violating the concept of prudence? Are we not violating the concept of conservatism? No, there is another provision. What it says, you will make provision for diminution. Provision for diminution shall be made to recognize a decline other than temporary in the value of the investment. Very important. Very important. 2-star mark. The reason is, many students believe that long-term investment will always be carried at cost. That is not true. I said temporary fluctuation can be ignored. Temporary fluctuation can be ignored. But if the decline is other than temporary, if the decline is permanent, it is a long-term decline, then the standard says apply prudence now. Apply prudence. Make a provision for permanent decline in the value of investment. For example, if you find that, suppose this is the graph of a company's share and it is continuously falling year after year. Maybe 6 months you will ignore, 3 months you will ignore, but you are finding that entire year the prices were falling. Last year also the prices were falling. Then you look at their balance sheet. Oh, there is a loss. Oh my God, loss. Look at their cash flow statement. There is a negative cash balance. There is a negative cash balance. Look at their shareholder fund. Shareholder fund has become negative. Look at the industry. The industry is already on the verge of collapse. Oh my God. This is an indicator that there is a permanent decline in the value of investment. So once you feel that this decline is not temporary, it is other than temporary, it is going to last long, make a provision for decline in the value of investment. Now how do you make that provision? simply pass an entry P&L account debit to provision for decline in investment value. To provision for decline in investment value. If you find that this decline is not temporary, that was my second point. Third point, this exercise has to be done for each investment individually. So if you have 3 investment, do this exercise separately for each investment. Do not apply global or overall approach. So if I have investment in A, B, C, I will apply this principle to each of them separately. I will not take a total and I will say on total basis we are gaining. Don't take total basis. The reason for not taking total basis is that if you take total of A, B, C, A's gain will nullify the loss of C. You will not get the lowest value. So therefore, always try to apply the concept of prudence or the provision requirement for individual investment and not on total basis. Is this understandable? Is this understandable? Say yes or no. Say yes, we have understood. Okay, everybody has understood. So today we'll stop here. We'll continue tomorrow from this point onward. Same timing. Please come on time so that you can get the maximum benefit. Okay. Thank you very much.